Hello everybody, my name is Elish Eisner and welcome to the Canadian Money Talk, a channel about Canadian investing and personal finance. Please like and subscribe. I record a video per week, so make sure you ring the notification bell to get notified each time one comes out. I had a question about bonds back in 2022 on the YouTube channel and I thought everyone would be interested in the answer, did a video, but was recently asked whether I could update this video since interest rates are coming down in 2024 rather than up as they were in 2022. Please do your own research in this matter before deciding on what to invest in. So to start us off, bonds are loans to governments or companies which pay interest, also called yield, and have a given duration, at the end of which the borrower pays back the principal to the lender. So here's some basic bond information. Investing in Canadian bonds offers several benefits. One is stable income. Canadian bonds provide a steady stream of income through regular interest payments, which can be attractive for investors seeking predictable returns. The next benefit is diversification. Adding Canadian bonds to your portfolio can help diversify your investments, reducing overall risk. Lower volatility. Bonds are generally less volatile than stocks, making them safer investments during market downturns. The lower volatility is to the up and the downside, so bonds generally don't average as high returns as stocks over time. Let's take a look at some broad bond classes. Number one, safe government bonds. Low risk, low yield. The government is not going to go bankrupt. Number two, investment grade corporate bonds. Higher risk, higher yield than the government bonds, but still reasonable. Canadian government and investment grade corporate bonds are considered low risk investments due to the high credit worthiness of the issuers. And then number three is we have high yield, also called junk bonds. High risk of the issuer not paying you back your principal, but to cover for that, they give high yield. Let's take a look at the interest rate environment. With predictions of interest rate cuts in Canada, bond prices may rise, offering capital gains opportunities. So as interest rates go down, as they are doing now, new bonds need to pay less interest. So fresh money is going to get lower returns in new bonds compared to the old bonds. Existing bonds with higher interest rate returns than the new bonds are now worth more. So their prices bid up. That is a capital gain to account for their higher returns compared to the new bonds when sold. Therefore, there's a price benefit to the upside in bonds with lower rates. Next, we'll look at bond duration. Bond duration is the date of the bond expiry when the lender gets their money back. This can be as little as 30 days all the way to 30 years. Short duration bonds have fewer payments to increase the bond's worth, so they get smaller benefits from decreasing interest rates. Longer duration bonds, because there's more payments, will appreciate more by interest rates going down. Next is taxation. I would suggest keeping bonds in a TFSA or an RRSP because interest is taxed as regular income in non-registered accounts, meaning highly taxed. Let's take a look at what's happening today. Investor money is going into Canadian aggregate bond ETFs and other investments, usually investment grade or better. Longer duration bonds will benefit more from the interest rate cuts and appreciate. And thus, bond ETFs with a weighting towards government bonds, which tend to have longer duration, seems to be more popular. Keep in mind, some rate cuts are already priced into the bond market yields, however. Now, a few years ago, buyers were buying for income as rates were high, but today, buyers are buying for capital gains as rates come back down, but yields are still decent. Canadian government bond yield curve has uninverted for the 2 and 10-year bond yields. As of November 1, 2024, the yield for the Canadian government 2-year bond is 3.11%, and the yield for the Canadian government 10-year bond is 3.26. This means longer-term bonds pay slightly more than shorter-term bonds, which means we're getting back to normal. Generally, longer term should pay more because the money is at risk and out of your hands longer. Let me make some suggestions, and please keep in mind this is not financial advice. There is a significant spread between different expiries and durations you can take advantage of as an investor. Going for longer terms around 10 to 20-year duration that yield more than the shorter term because of the inflation expectations having come down for the short-term bonds. I'm seeing growth opportunities in intermediate maturity corporate bonds, and Canadian investors should be taking advantage of these attractive valuations. There's no global slowdown apparent at this time, and bonds will benefit. Valuation on corporate bond yields and total return has come down in the last 2 years. Fundamentals are based on economic future growth, with the threat of short-term inflation having passed and the fundamentals looking further ahead. The bond markets are expecting continued rate cuts in 2025. Looking out even further, if the world is still in a low level of growth, the bonds will be doing very well. Corporate bonds are good because Canadian corporations have pricing power and are likely to do well and avoid defaults. The balance sheets are strong, but their bonds pay higher yields than government bonds while being nearly as safe. The spread between the two is compelling towards corporate bonds. Many of the corporations, especially in the energy sectors, may not need to refinance the corporate debt because they have so much free cash flow they can pay their debts off. Investors will be looking to buy more existing corporate debt with the higher yields, but there won't be much available, bidding its price up. Bonds are not meant to be the big earners in a portfolio, but rather the safety and the ballast. Even with the recently lower yield from fixed income today, you may be able to get a similar cash flow as you can from dividends on stocks, yet with less volatility. If you have any requests on what you'd like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.